Piyush, firstly, thanks very much for taking time out to talk to us. Now, we spoke exactly a year back when things were looking very different. At that time, there was this hope that things would get better. Today, we're sitting with this huge concern that things would get a lot worse from here. How are you viewing it?
I think that's a good way to define it. I think if you look at what happened over the last 12 months, things actually didn't pan out as well as several people, including myself, were hoping they might. I think the first and the biggest issue has been Europe. Europe turned out to be a bigger problem than people anticipated. Not because the fundamentals of Europe were misunderstood, or not because people did not understand the math. It was because I think there was perhaps a misplaced sense of confidence in the willingness of the leadership in Europe to drive a European solution. Right? So the notion that the Euro project had so much momentum that all of the leadership, Germany included, would bend over backwards to make it happen was pretty high. In reality, what seems to have happened is that over the last few months, it's quite clear that the understanding of the Euro project, or at least the broad public acceptance of the Euro project, is not as strong as people thought it was. And therefore, certainly the Germans have not been as willing to come to the party as people thought they would be. That's created a much higher degree of uncertainty around the ability of Euroland to get its act together. And that has had important implications both on the West, i.e. on the US, and on the East, which is on China. In the US, if you figured, people figured towards the end of last year, growth rates are beginning to acquire some momentum. In fact, even the first quarter this year, early this year, there seemed to be some momentum. The last 4 or 5 months, the momentum seems to have been running out. Growth has been a lot more anemic. And some of that has to be linked to the confidence issue spilling over from Europe. In China, similarly, right from the beginning of this year, exports have slowed off, and that had to do with Europe. More importantly, in the last 6 or 8 weeks, domestic demand is coming off. And that, again, is a confidence issue stemming from a European crisis situation. So net-net, when you put it together, I think the way you described it is perhaps right. Things look a little bleaker today than they were a year ago.
Sure. Now, for the CEO of an Asia-centric bank who's sitting in the relative safety of a region that's not been too affected by the crisis we've seen play out in other parts of the world, what are the opportunities you see?
These things are always a double-edged sword. On the one hand, the global economy, and especially the financial markets, are so tightly integrated that a slowdown in any one part of the ecosystem actually creates challenges in other parts of the ecosystem. The other side of the sword, though, is what you allude to, that as competition reduces because some of our Western counterparts are less active, that clearly throws open opportunities for us as an Asian bank. So the obvious area in which we benefited over the last year was trade finance. We gained substantial share in trade finance across Asia, mostly China, Hong Kong, Greater China related. And that was driven by 2 things. One, domestic policy tightening in China through a lot of trade finance offshore from onshore. Second, the European banks pulled out, especially the French banks pulled out. And that created a very significant market opportunity for regional Asian players like ourselves. So that was an immediate opportunity. Now, this is not just an opportunity to book some assets. It really gives us opportunity to build a much broader customer franchise. We're seeing that in India too. As there's been some tightening in liquidity, it allows a bank like us with a lot of capital and liquidity to work our way into corporate positions that in the normal course we might find more difficult to get into.
So now, bank balance sheets are expected to shrink over the next 2 to 3 years as banks work towards enhancing their capital. Now, the deleveraging process in Asia is not expected to be as intense as it is going to be in Europe. Would you say that this actually throws up a significant opportunity for Asian banks?
Absolutely. Absolutely. The bulk of the deleveraging that you'll see over the next 2-3 years will really be European deleveraging. There is continued deleveraging in the US, but a substantial chunk of it is behind them. So there's actually a lot of liquidity in the US, but there is definitely issues in Europe. In Asia, as you suggest, banks have capital and banks generally have liquidity. And so while Asian banks do get constrained in terms of the dollar book, because dollars tend to be less liquid, on the whole, there is capacity to be able to replace some of the European limitations, a limited supply. And so absolutely, you can see that today. The Japanese banks, some of the regionals like ourselves, the Australian banks, are all being able to benefit from the pullback by the Europeans and the need to deleverage less than the Europeans.
Very often it is said that regulators, when they try to address the problems of the past, tend to sow the seeds of problems for the future. Now, the Basel III capital requirements in some part are being seen as one of those problems that could crop up in the future. The NSFR is one issue that has come under severe criticism from banks across the world. Do you worry that Basel III could actually stand in the way of progress for the banking system?
Well, the Basel III, got to remember, first of all, is not just an outcome of the global financial crisis. This is a process that has been running for the last 20 years in terms of trying to get banks more risk sensitive from a capital adequacy standpoint. I think the liquidity focus has been more profound in the last 2 or 3 years. And as you think about the reasons behind the crisis, lack of capital, inadequate capital, liquidity being pulled out, some of the measures that are envisaged are logical. We do collectively need to strengthen the overall banking industry, and so there's somewhat smart things or rational things to do. There are 2 fundamental problems, I find, or 3, with the Basel regime. One is it continues to perpetuate a very heavy reliance on internal models. Now, the reality is that the crisis has demonstrated that models are open to issues, problems. The Basel continued focus on models doesn't address that fundamental issue. Right? So in fact, you get to a situation where every bank is going to determine its own capital requirements based on its own internal models, and therefore it's beginning to make regulators quite uncertain about whether they can compare apples and apples or compare people across the level playing field. So that's an issue. The second big issue that Basel creates is this ring fencing issue. So increasingly, every regulator is trying to ring fence capital and liquidity within their own jurisdictions. Unfortunately, this results in inefficient use of capital and results in what I call ponds of liquidity as opposed to a flowing river of liquidity. And I believe that in years to come, this will have some pretty profound impact on overall growth opportunities and growth prospects. So this is your specific question. I do believe that in going through a lot of the Basel prescriptions, we will create problems, headwinds, in terms of economic growth as we go forward. It's not going to be straightforward.
So when you talk about these ponds of liquidity that regulators across the world are insisting on to protect their geographies, do you believe that's the price that global banks such as yours will have to pay if you want to get greater access to newer markets?
It's a trade-off. It's something that we're trying to work with the regulators at a global level. In fact, I'm on the board of the IIF. It is one of the most important issues that we're trying to address with the Basel Committee and with the FSB. That at the end of the day, we need to find collectively a balanced outcome. An outcome which is good for the industry, an outcome which ensures that taxpayers do not bear the brunt of the follies of global banks. But at the same time, we don't wind up with a set of recommendations and policy prescriptions that make the global industry inefficient so that it takes percentage points off global economic growth. That would not be a good outcome either. And therefore, we are currently in the process of engaging with the global authorities to try and find the right balance. Today, some of the prescriptions around both the NSFR as well as the liquidity ratios are limiting. And if we go through with those ratios in the current form, they will very definitely create an issue from a slowdown standpoint in the macroeconomy.
No, but you'd agree that when the Basel III, many of these elements that you've spoken of were drafted, it would have in some part been drafted keeping in mind what we saw happen in 2008, to some extent at least. So would you say, we keep talking about new normals in the financial world, that these are some of the new normals that banks will have to get used to working with, and that in order to adjust for profitability or return on capital, the customer will just have to get used to higher intermediation costs?
I think there are 2 separate issues here. The one issue is what are the impacts on the global economy. And therefore, if the premise is that worldwide people should adjust to lower rates of growth as a consequence of capital and liquidity inefficiencies, I don't think that that is something which mankind in general, societies in general, should really compromise for. The second set of issues is what does a set of legislation mean for returns for banks, and therefore what does it mean for investors and investment opportunities. I believe banks will have to adjust for that. I do believe that there will be lower returns on banks as banks get more solid and more safe, and therefore that adjustment is something that the investor community will have to adjust for in time.
Now, you talked about, you're sitting on the board of the IIF. The IIF has had some, fairly strong views on the crisis playing out in Europe and the haircut that a lot of banks have had to take on the European exposure that they've had. How are you viewing it? Do you believe that this is something that banks will just have to get used to, or that there could possibly be some way out of it there?
Frankly, I think this is a truism. The most global financial crises result from too much leverage. And if you have too much leverage in the system, at some point in time, people have to take knocks to capital, right? And therefore, you call them haircuts. I think the history of the world is that over time, when there's too much debt, there will be haircuts. So the question is really, what is the appropriate quantum of haircuts? And perhaps more importantly, how evenly is that haircut distributed? I think one of the bigger issues that we at IIF had is that when you create a regime where you create different priority preferences, i.e. official creditors do not haircut but private creditors haircut, then you create inefficiencies in the overall markets. When the 100 billion package for Spain was announced, the markets tanked. And they tanked because the package was announced as a bailout of the sovereign, or paid through the sovereign into the banks. And the market's immediate reaction was, well, that means that this amount, 100 billion, will be senior and superior to any other credit which has been given to the banks. And the markets didn't react kindly to that. So I think being able to get the right rules of engagement, so the pain is shared equally and fairly among different levels of creditors, is really what the IIF is seeking to achieve.
Now, just focusing on the global situation, Europe isn't getting any better. The US growth continues to remain anemic. Is there this, I don't know whether sitting in Asia, we should call it a worry that quantitative easing could be around the corner, that Europe will push through another round of LTRO, or possibly the US could push through another round of QE? And the impact of that on Asia, do you worry about the likelihood of overheating in Asian economies on account of that?
Yes, absolutely. This happened last year with the QE2, and I'd say the odds are there will be another QE sometime over the next several weeks, maybe LTRO. And the impact on that in Asia, frankly, all emerging markets, is detrimental. By and large, our markets are not very deep. And therefore, waves of liquidity that flow into our system can really create a lot of volatility, both short-term volatility, but more importantly, they wind up with asset price inflation. So it then is left to central banks, regulators, and governments to try and manage this. And you're in a conundrum, because if you try to manage it through tight monetary policy, you raise rates, you wind up with slowing down already slowing economies, but you also create further catalysts for more money to come in. And therefore, what you try to do is manage through macroprudential regulations as opposed to monetary policy. And there are only that many tools you have from a macroprudential standpoint. So I think the big challenge for Asian regulators, central bank governors, frankly, in the short as well as in the medium term, is going to continue to be how do you manage this issue of a lot of inflight of capital and managing around the asset price and inflationary concerns around that. This gets particularly compounded because the money, the liquidity that comes in also moves out equally rapidly. So you cannot even plan for this in an extended period of time. These are short-term flows. Last year, about a year ago, July, August, the Singapore dollar, the swap rate went negative. So for the first time in Singapore's history, we had a negative interest rate, purely on the back of QE flows. Now, a negative interest rate is really inefficient from a resource allocation standpoint, but those are the kinds of challenges which most of the Asian regulators are going to have to continue to work with, central bankers are going to have to continue to deal with over coming months.